Hey everyone, and welcome. Today we are diving deep into one of the most heavily tested areas on your exam: corporate debt and money markets. Look, mastering the relationship between bond prices and yields, it isn't just helpful, it is a huge advantage. And today we're going to make it surprisingly simple. So let me kick things off with a question for you. Do you have any idea what the single most common math trap is that test takers fall into? It has everything to do with how bond prices and yields relate. And getting it wrong can cost you some really precious points. And the answer is this: forgetting one simple, powerful idea: the bond price seesaw. I'm telling you, this one little metaphor is the key to unlocking basically every yield question you're going to face. So let's break down exactly how it works. Okay, so here's our game plan. We're going to build that seesaw foundation, then we'll decode all the different yields, we'll nail down the crucial rule for accrued interest, run through some money market fast facts, see why regulators are so focused on this right now, and then wrap it all up with a rapid-fire review. First up, building the seesaw. All right, let's get into it and build this seesaw. Every single bond has three core parts, and once you get these, I promise everything else just kind of falls into place. Everything, and I mean everything, starts with par value. You might also hear it called face value. Just think of it as the original loan amount. For corporate bonds, you should always assume it's $1,000. This is the cash the investor gets back when the bond matures. It's our starting point, our anchor. Okay, next up we've got the coupon, which is also called the nominal yield. This is just the fixed interest rate the bond pays every single year. So if we have a 6% coupon on our $1,000 bond, it's going to pay $60 in interest every year. And here is the most important part: that coupon percentage, it's locked in the day the bond is issued. It never ever changes. And that brings us to the price. Now, unlike the par value and the coupon, the price is constantly changing out in the open market. It's quoted as a percentage of par. So a quote of 98 doesn't mean $98, it means 98% of par, which is $980. A quote of 102, that's $1,002. This is what moves, and it moves mostly because of changes in market interest rates. And here it is, the big reveal. This is our seesaw in action. It's beautiful, right? When interest rates out in the world fall, any new bonds being issued are going to pay less. Well, this makes those older bonds with their higher coupons look way more attractive, so their prices go up. And here's the trick: as that price goes up, the overall rate of return, or the yield, for a new buyer goes down. And of course, the reverse is true. When market rates rise, those older, lower coupon bonds look, well, kind of lame. Their prices fall, which means their yield goes up for anyone who buys them today. It's a perfect inverse relationship: price up, yield down, price down, yield up. Okay, now that we have that seesaw in our heads, we can decode the four types of yield you're going to see on the exam. And the key here isn't just memorizing formulas, it's understanding how they all tie back to the bond's price. First up is current yield. This gives you a really quick snapshot of the return you're getting based on what you pay for the bond right now. The formula is super simple. Just take that fixed annual coupon payment and divide it by the current market price. So for our 6% bond paying $60, if it's priced at $980, its current yield is actually a little over 6%. But if it's priced up at $1,020, its current yield dips below 6%. See? It moves with the price. Next, we have yield to maturity and yield to call, or YTM and YTC. YTM is your total return if you hang on to that bond all the way to the end. It includes all the coupon payments plus any gain or loss between what you paid and the $1,000 you get back at maturity. YTC is the same idea, but it's your return if the issuer calls the bond, meaning they pay it back early. Now, why would they do that? Simple: to refinance their debt at a lower rate, just like you might refinance a mortgage. This is a huge risk for anyone holding a pricey, high-coupon bond when market rates have tanked. Now look at this slide. This is your ultimate cheat sheet. When a bond trades at a premium, that means its price is above par. The yield order from lowest to highest is always YTC, YTM, current yield, and then nominal yield. For a discount bond, it's the exact opposite. Seriously, burn this image into your brain. This latter is pretty much a guaranteed point on your exam. Okay, let's shift gears and tackle a little detail that trips up a lot of people: accrued interest. So, what happens when a bond is sold between its interest payment dates? Who gets the interest that's been earned but hasn't actually been paid out yet? The rule is simple: the buyer pays the seller. Now, why? Well, think about it. On the next payment date, the new owner, the buyer, is going to get the full check for the entire interest period. So it's only fair that the buyer pays the seller back for the portion of interest that was earned while the seller still owned the bond. For corporate and municipal bonds, the calculation is based on a handy shortcut, a 30-day month and a 360-day year. On the exam, just remember, buyer pays seller, and you'll see this pop up on the buyer's trade confirmation. All right, we've been talking all about long-term corporate bonds. Now, let's flip the script and talk about the complete opposite end of the spectrum, the super short-term debt we call money market instruments. You want to think of these as safe, temporary parking spots for huge amounts of cash. They all share three core traits. They are very high quality, highly liquid, and have a super short maturity. For the exam, you've got to know that T-bills and commercial paper are issued at a discount to their face value. On the other hand, things like negotiable CDs are basically giant savings deposits that pay interest. The main takeaway here is always safety and liquidity. So you might be thinking, okay, this is great for the exam, but what about the real world? Well, let me tell you, mastering bond pricing matters a lot out there because FINRA, the big industry regulator, is making it a top priority for 2025. Regulators are really clamping down on firms to make sure they're providing fair pricing and achieving best execution for their clients. In plain English, that means firms have to prove they're getting the best possible prices when they buy or sell bonds. It goes right back to our Seesaw. Understanding price and yield isn't just for a test. It's at the very heart of protecting real investors in the real world. All right, time to lock this all in. Let's do a super quick rapid-fire review of what you absolutely have to know for test day. This is your final cheat sheet. Okay, remember, price and yield are a seesaw. One goes up, the other must go down. For a premium bond, the yield to call is your lowest possible yield. For a discount bond, that fixed nominal coupon is the lowest. Corporate bonds, they use the 30/30/60 day count for accrued interest. And money markets, just think short-term, high-quality debt. Got it? All right, you ready? Let's put this to the test. A 6% corporate bond is priced at 96. What is its current yield? Okay, remember the formula. Annual coupon divided by market price. The annual coupon is $60. The price, quoted at 96, is $960. So 60 divided by 960, that comes out to 6.25%. The correct answer is B. Okay, next question. A premium bond is most likely to be called by the issuer when? What do you think? Just think about why a company would call a bond. They do it to save money by refinancing at a lower interest rate. And that's only going to be possible if market rates have fallen since the bond was first issued. So the correct answer here is A. All right, a little memory test for you here. Which of these uses that 30/360 count convention for accrued interest? This is just pure memorization. Government bonds use actual days, but to keep things simple, corporate and municipal bonds use the 30-day month, 360-day year rule. That makes C, corporate bonds, our answer. And for our final question, which of these is not typically a money market instrument? Remember, the magic word for money markets is short-term. A long-term corporate debenture is, well, by definition, not short-term at all. So the answer is C. Fantastic work. You are now armed with the core logic behind bond pricing. So the real question to ask yourself is this. Now that you understand how falling rates can boost bond prices, how might that change the way you look at an investment portfolio in different economic cycles?